Today, we're digging into a pretty wild story. The source material for this explainer claims that while most of us were asleep, a secret deal was cut by some of the most powerful people in finance. Their goal? To stop the price of silver dead in its tracks. So let's get into it. Here's how we're going to break this whole thing down. We'll start with that supposed secret call, then look at the agreement they allegedly made at $75. We'll explore why that specific price is so important, and then look at the evidence for an attack that's supposedly already happening. After that, we'll get into why our source thinks this plan is doomed, and finally, what the market's reaction might be. All right, first up, the event that supposedly kicked this whole thing off. A secret meeting that happened in the dead of night. I mean, it's a great question, right? The core idea here is that the biggest moves in the market don't happen out in the open. Nope, they happen behind the scenes, in the quiet hours when almost nobody is paying attention. According to our source, the time was precise, 1:34 a.m. It's claimed this call lasted exactly 47 minutes, and you guessed it, no official record was kept. This wasn't just some friendly chat. It's described as an emergency meeting with one single purpose: stop silver from crossing a price that could, quote, trigger a systemic collapse. And you gotta see who was allegedly on this call. We're not talking about a few traders. We're talking about the global head of commodities at JP Morgan, the head of derivatives at HSBC, the CEO of the CME exchange itself, a top official from the US Treasury, someone from the Bank for International Settlements, and the chairman of the London Bullion Market Association. I mean, if true, this is coordination at the highest possible level, from giant banks to the regulators. So, if this call actually happened, what did they decide? Well, that brings us to the so-called gentleman's agreement they reportedly reached, and it had a very specific goal in mind. The plan allegedly had four main parts. First, they'd work together to dump a ton of paper contracts anytime silver started getting close to their target, just to spook the market. Second, they'd use their political muscle to lean on ETFs and stop them from buying up physical silver. Third, the Bank for International Settlements, that's kind of like the central bank for central banks, would provide unlimited cash to any bank that got in trouble holding the line. And last, they'd kick off a big media campaign to get everyone to think selling is a good idea. And this right here is the heart of it. The source claims a message was sent out from someone on that call. It was short and to the point. 4 words. The line in the sand, the price that absolutely could not be crossed, was $75. Okay, but why $75? It sounds kind of random, right? Well, according to the source, it's anything but. Now we get into the math, the mechanics that supposedly turn this one price into a ticking time bomb for the whole system. So yeah, this is the key question. What is so special about this number that it could cause a systemic collapse? The answer isn't about feelings or emotions. It's about the cold, hard wiring of the options market. At the center of this whole mess are these 41,000 call option contracts. Now, each one of those represents a ton of silver. All told, we're talking about an exposure of 205 million ounces, all betting that silver blows past $75. And you know who sold those options? The banks. They probably thought it was easy money, and now they are on the hook for a mountain of physical silver they just don't have. Now, to really get why they're in so much trouble, we gotta quickly talk about something called delta hedging. Don't worry, it's not as scary as it sounds. Just think of it like this. It's an automatic safety switch. When a bank sells you that call option, their risk goes up as the price of silver goes up. So, to balance that risk, their computers are programmed to automatically start buying the real thing, actual physical silver. And here's the key. It's not a choice. It is a forced, automatic buying pattern. And this chart right here, this is the whole problem. If silver hits $75, those automatic delta hedging programs would be forced to buy about 200 million ounces of silver. But the entire registered inventory of the COMEX, the main place you trade silver futures, has less than 25 million ounces ready to go. They would need 8 times more silver than physically exists in the vaults. That's the death spiral. So, we have the alleged meeting, and we have a very clear motive. Now, let's look at the proof our source points to, arguing that this isn't just a theory anymore. It's already happening. The source points a finger directly at the trading on December 24th. Silver got up over $72, getting way too close for comfort. And what happened next is described as a midnight attack, a huge coordinated dump of paper contracts to slam the price down more than $2.50 really fast. The goal, supposedly, was to break the market spirit and trigger a panic sell-off. But here's the kicker. It didn't work. Physical buyers apparently jumped in and bought up that dip like there was no tomorrow, and the price shot right back up by the end of the day. The source sees this as a huge win for the physical market, a sign that these paper games are starting to lose their punch against real-world demand. So if the direct attack failed, what's plan B? Well, it's psychological warfare. The source says a coordinated media blitz is on its way. They say to keep an eye out for headlines and TV experts all singing the same tune. Silver's too high, industrial demand is falling, it's time to sell and take your profits. It's described as an attempt to basically gaslight investors into dumping their metals. Now, even with all these incredibly powerful people involved, the source is absolutely convinced that this plan is going to fail, and it all comes down to two fatal flaws in their alleged agreement. The first flaw is this critical difference between two separate markets. You have the paper market, where the banks can create and sell a nearly infinite number of contracts. It's a market built on promises. But then you have the physical market, which deals in real bars, real coins. That's a market of stuff you can actually hold. And the argument is that this physical market is driven by a real-world supply problem that no amount of paper games can fix. And that supply problem is enormous. The source claims there's a 1.1 times billion-ounce physical silver deficit in the real world. As long as buyers are willing to pay up for the real metal, they will continue to drain the actual inventory from places like the COMEX. You just can't print physical silver. The second fatal flaw is just human nature, greed, and survival. The source calls it a classic prisoner's dilemma. Okay, so all the banks agree to work together, but in the back of its mind, each bank is terrified that another bank is going to cheat and start buying silver first to save its own skin. If that happens, the price goes to the moon and everyone else goes bankrupt. So what do? Well, the incentive is to be the first one to betray the group, which of course triggers the very buying panic they were all trying to stop. And that brings us to the end game. What does the source believe is going to happen, like right now? What's the final takeaway from this whole incredible story? Okay, so the source lays out a very specific, very testable prediction for the next couple of trading days. They expect to see ferocious selling to defend the line just under $75. But if the market can manage to close for the day above that price, the trap is sprung. The forced buying kicks in, the shortage becomes obvious to everyone, and the price is expected to jump way higher, way faster than anyone thinks. So to wrap it all up, our source material describes a secret plan to cap silver at $75. But it also argues that plan is destined to blow up in their faces because of physical reality and basic human greed. The final thought here is a powerful one. A small group of people may have agreed on a price, but as the slide says, the market is about to disagree.